Welcome back to the Deep Dive. Today, we are going to be talking about something that kind of sits underneath everything. We're not talking about interest rates or inflation. Not really.
Not in the usual way, at least.
No. We're not even really talking about the stock market. We are talking about the plumbing, the invisible infrastructure that dictates how money, how value moves around the world.
And that's such a great analogy because when you start messing with the plumbing, you don't just change the pipes, you change the entire building.
Right.
You end up changing who gets water, when they get it, and more importantly, who controls the main valve.
Exactly. And we are standing right now at what our sources for this deep dive describe as a massive historical intersection, a crossroads.
Mm-hmm.
This isn't just another financial trend. It's a fundamental shift in the very nature of money itself. We're moving from money as this passive tool, a coin in your pocket, a bill in your wallet.
Something you own, something that just sits there.
Yes, something that sits there until you decide to use it. We're moving from that to money as an active, programmable tool, a tool of policy and potentially of control.
And look, it sounds like something out of a science fiction novel, or maybe, a dark conspiracy theory you'd find online.
It really does.
But then you start reading the actual papers from the central banks. You look at the Bank for International Settlements, the white papers, the technical specs being rolled out right now, and you realize this isn't theory, this is happening.
We are talking, of course, about CBDCs.
Central Bank Digital Currencies.
Yeah, I know, I get it. CBDC might be the single most unsexy acronym in the entire English language.
It's terrible.
It sounds like a mild medical condition or, I don't know, the bureaucratic department you'd do anything to avoid.
Agrees. It sounds incredibly dry. There's no glamour to it.
None. But the sources we are covering today, a really fascinating roundtable, they argue that this very dry, very boring acronym represents and this is a quote, the final piece of the puzzle.
A puzzle that's been assembled for 50 years.
It's exactly a 50-year shift in global finance. They say this is the bridge from the old world of banking, with all its flaws, to a new world of, total algorithmic oversight.
And to really understand this, we're digging into a really heavy-hitting roundtable discussion. The title of it is We Stand at a Crossroads.
And this isn't just, cable news pundits shouting at each other.
No. This is the real deal. We've got Rabi Atif, who's a serious financial expert, someone who really understands the markets from the inside. Then there's Stephen Dirks, an IT lawyer who gets the code, the technology underneath the law.
Which is so important here.
Crucial. And finally, Hester Bass, who's a financial law attorney and an author. She understands the legal frameworks that make all of this possible.
So you've got the money guy, the tech lawyer, and the financial legal expert. That's the trifecta.
It is. And their whole approach, the vibe of this discussion, is strictly follow the money. It's not about ideology, it's about mechanics. They connect history, law, and technology to show us this big shift.
What's the shift?
We're moving from a system based on trust. And, you can argue about how flawed that trust is, but it's still based on trust.
Right.
We're moving from that to a system based on absolute verification, on absolute control.
So our mission today, for you, is to decode this beast. We really want to answer three big questions. First, what is the actual mechanical difference between the digital money I use right now on my phone, my Apple Pay, and CBDC? Because they sound the same. They do. It's a key point of confusion.
Second, what on earth does programmable money actually mean? We hear that phrase a lot, but what does it look like in practice?
And third, the big one.
Yeah.
Why now? Why is all of this happening in the 2020s? What's the context?
It feels like it all comes down to a story about freedom, really, and whether our idea of autonomy is even compatible with the next generation of financial tech.
That's the core of it. Okay, so let's start with the basics. Section 1, defining the beast. Because I think this is where everyone gets tangled up. I use a debit card. I use PayPal, Venmo. I honestly can't remember the last time I used a significant amount of physical cash.
Maybe for a coffee or something small.
Right. So my money feels like it's already digital. So when I hear the government say, we're launching a digital currency, my first reaction is just, don't we? Don't we already have that?
And that is the single most common misconception. It's the hurdle we have to get over right at the beginning. And Hester Bass, the attorney in our source material, she clears this up so well right out of the gate.
Okay.
To understand a CBDC, you have to first understand what your money is right now. When you open your banking app on your phone and you see a balance, say, €1,000 or $1,000, what are you actually looking at?
I'm looking at my money. It's my $1,000, my savings.
Technically, no. And this is the part that blows people's minds. You are looking at something called commercial bank money.
Commercial bank money.
Yes. That number you see on the screen is a liability. It's an IOU. It is a claim you have against a private company, your bank, whether that's ING or Chase or HSBC or whoever.
So it's not actually money, it's a promise from my bank to give me money.
Precisely. You have effectively loaned them your money, and they have given you a digital IOU, promising to give it back when you ask for it at an ATM or, use your debit card.
Okay, so it's a debt that a private business owes me.
Exactly, and that business can fail. We all saw it in 2008. We saw it more recently with Silicon Valley Bank. If the bank goes bust, your claim, that digital number on your screen can, in theory, just vanish.
Well, unless the government steps in. Deposit insurance and all that.
Right, unless the government bails out the system. But the core relationship is between you and a private company. That's the key.
So then what makes a CBDC so different?
A CBDC is central bank money. It is a direct claim on the central bank itself, the Federal Reserve in the U.S., the European Central Bank in Europe.
It cuts out the middleman.
Completely. Imagine you just bypass your local bank branch, your commercial bank, entirely. And instead, you have a digital wallet that is provided, maintained, and crucially, monitored directly by the state.
So instead of banking with Chase, I'm banking with the government.
Effectively, yes. Now, the commercial banks might still provide the front end, the app on your phone, the customer service, but the actual money, the liability, sits on the central bank's ledger.
Okay, so that's a big structural change. But the source says the bigger difference isn't just who holds the IOU.
No, it's the technology underneath it all. Our sources are clear that CBDCs are being built on a variation of blockchain technology, or more broadly, distributed ledger technology, DLT.
Okay, so like Bitcoin or other cryptocurrencies?
Well, yes and no, and this is a really important distinction. It uses the same architectural idea as Bitcoin, this concept of a shared immutable ledger, but it's used for the exact opposite purpose.
How so?
Bitcoin was designed from the ground up to be decentralized. No single person or entity controls it. No one can censor transactions. It runs on a global network of thousands of computers.
The whole point is that nobody's in charge.
Exactly. A CBDC is the polar opposite. It is hyper-centralized. It is a ledger where the central bank, and only the central bank, has what you might call God mode.
God mode. That sounds a little ominous.
It's an accurate description, though. In a CBDC system, the ledger is the ultimate source of truth. Once a transaction is recorded on it, it is unchangeable. It's permanent.
I guess that's good for preventing fraud, right? The double spend problem.
Oh, absolutely. It solves the double spend problem perfectly. You can't spend the same digital euro twice, just like you can't photocopy a physical coin. But what it also means is total, absolute traceability.
And that's where we get to cash. The sources talk a lot about this ongoing war on cash.
They do. And they break down why cash is so unique and why governments and central planners seem to, hate it so much.
What's so special about a $20 bill?
Cash has three distinct attributes that digital money, as we know it, generally lacks. One, it is anonymous. If I buy a used lawnmower from you for $50, cash, nobody in the world knows about that transaction except you and me.
No record.
None. Two, it offers transaction freedom. I don't need anyone's permission to hand you that $50 bill.
Yeah.
The transaction clears instantly just between us. It's peer-to-peer.
And three.
It works without a third party. If the power grid goes down, if the internet is out, if the banking servers crash, cash still works. It's resilient.
Okay, so anonymous, permissionless, and resilient. What about a CBDC?
A CBDC removes all three of those attributes. It is not anonymous. Every single transaction is logged in the central ledger forever.
Wow, forever.
Forever. It is not permissionless. The central ledger has to validate and approve the transaction before it goes through, and it is completely dependent on the third party, the central bank's servers, to be online and functioning.
And the sources mention that this war on cash isn't just a theoretical idea. It's happening right now. We're being conditioned for it.
Right. Robbie Atley, the financial expert, points this out. We are effectively being trained right now to accept this shift. Just think about what happens today if you try to use a large amount of cash. Say you go to your bank and try to withdraw $5,000.
You get the look. The teller looks at you like you're about to do a drug deal.
You get the look, and then you get the paperwork. A currency transaction report. You are flagged. You have to explain in detail why you want your own money.
What is this for? Where are you going?
Do you have a receipt for what you're about to buy? The entire system is built to treat the desire for physical, private money as inherently suspicious.
They're just tightening the screws little by little.
They are, and the CBDC is just the logical endpoint of that trend. It's a system where the suspicion is completely automated, and the physical option, cash, simply ceases to be a viable alternative. You move from a world where anonymity is the default for small transactions to a world where total visibility is the default for everything.
This idea, this automation of suspicion, it brings us to the part of the source material that really made me sit up straight. Section 2. Programmable money. This is the phrase that keeps coming up, not just in this roundtable, but in the official white papers from the central banks themselves.
This is the, as you might say, the spicy part of the discussion. This is the real game changer. This is where we move from money being a passive store of value, a gold coin sitting in a chest minding its own business, to money itself acting as software.
The source used the phrase, money gets a code. What does that actually look like in practice? How can money have a code attached to it?
It's because the currency is no longer a physical object or even just a number in a database. It's a token on a centrally controlled ledger. And because of that, the issuer, the central bank, can attach conditions, rules to the token itself.
So it's not just, here is 100 euros.
No, it's here is 100 euros in, or here is 100 euros, but only for...
Okay, I need a concrete example. This feels very abstract.
Okay. One of the big concepts the sources discuss, which sounds radical, but is technically very simple to implement with a CBDC, is the expiry date.
An expiry date on money, like a carton of milk.
Exactly like that. Imagine the economy is in a deep recession. People are scared, so they're hoarding cash. They're saving their money, not spending it. They aren't buying new cars, new TVs, new anything.
And the central bank wants to stimulate the economy. Usually they'd lower interest rates to encourage borrowing and spending.
Right. But that's a blunt instrument. It's like trying to perform surgery with a sledgehammer. And what if interest rates are already at zero, or even negative? They're stuck.
The infinite zero lower bound.
Precisely. With a programmable CBDC, they could take a much more direct approach. They could introduce negative interest rates directly onto your wallet balance. Or, even more aggressively, they could program the money to rot.
To rot.
Yeah. You receive your salary on the first of the month, but that specific digital token you received has a piece of code attached to it that says it will lose 10% of its value if it's not spent by the 30th.
Oh, wow. So I literally can't save it. I am forced to spend it, or it just evaporates.
It forces consumption. It turns you from a saver into a spender by the force of code. It solves that classic paradox of thrift by simply making thrift impossible.
That's wild. Okay, what about the other side? Not just forcing me to spend, but restricting what I can buy.
That's the other big function. It's called earmarking. And we already have primitive versions of this in our lives.
Like what?
Food stamps, government benefits, or even a simple gift card. A book token can only be used to buy books. You can't use it to buy beer. A CBDC allows the issuer, the government, the central bank, to apply that same logic to your general salary, to all your money.
So let's play out a hypothetical scenario. The government passes a new aggressive climate law.
Perfect example. The source suggests scenarios where, for instance, you might have a personal carbon wallet alongside your normal wallet. Let's say you have the money in your account to buy a plane ticket to Bali. You have the euros. But if your carbon allowance on the central ledger has been maxed out for the year, the transaction is simply declined. The money itself knows what you're trying to buy. It knows who you are and what your carbon limit is, and the code decides if the transaction is allowed to proceed.
So you get an access denied message. Not because you're broke, but because you've breached a policy that's been coded into the currency.
The money becomes an automated tool of public policy enforcement. And this is so important, the source material emphasizes that this isn't just some far-off future. We are already seeing this gatekeeper dynamic in our current banking system, even without the full automation of CBDCs.
Right. Banks aren't just vaults anymore. They're deputies.
They are. And that story from Rabiatel in the roundtable, the one about the tires, that really stuck with me.
Me too. It just perfectly illustrates the mindset we're already dealing with.
So to recap for everyone, a man withdrew 2,000 of his own euros in cash. He was traveling to Turkey, and specifically, he was going to be near the Syrian border.
Okay, so you can see why that would raise a flag. It's a geopolitical hotspot. The bank's compliance department probably went on high alert.
Of course. And they did. They flagged the transaction. They froze his accounts. They demanded to know in detail what he did with that cash.
And he told them the truth.
He said, I bought car tires.
Car tires, a totally normal, boring purchase.
You'd think so. But the bank didn't just say, oh, okay, our mistake, never mind. No, they dug in. They argued that car tires are dual-use goods.
Dual use, what does that mean?
It means they have both a civilian and a potential military application. You can put tires on a family sedan to drive to work, or you could theoretically put those same tires on a Toyota Hilux being used by a militia or a terrorist group.
Kidding.
No. And because of that theoretical possibility, this regular citizen trying to buy tires was treated as a potential terrorism financing risk.
For buying tires with his own money.
Yes. The bank acted as the police, the judge, and the jury, all based on an algorithm and a compliance checklist. The takeaway from the source is clear. Under the current anti-money laundering, or AML rules, we are all treated as potential criminals until proven innocent.
And a CBDC would just automate that. It would cement it into the system.
Right. It removes the human element, the branch manager you could at least try to argue with, and it replaces him with an algorithm that just says transaction prohibited, full stop.
It's the computer says no sketch, but for your entire economic life.
And there's no appeal process for code. If the algorithm flags you, you're locked out. It's as simple as that.
So how on earth did we get to this point? This feels like such a massive fundamental shift from how money used to work. Section 3 of our dive looks at this, the historical arc. Because the sources are very clear, this didn't just pop up out of nowhere last year.
Not at all. This is a 50-year project. Whether it was intentional from the start or just a series of steps that led here, the result is the same. The experts in the roundtable traced the very beginning of this back to the 1970s.
The Nixon shock.
Specifically, the Nixon shock of 1971.
That was when the U.S. unilaterally took the dollar off the gold standard for international settlements.
Correct. And that's a moment people hear about, but maybe don't grasp the full significance of. Before that, for all its flaws, money was tied to a real physical asset. A dollar was a claim on a specific amount of gold held in a vault.
It was an anchor.
It was an anchor. Nixon cut the rope. Money became fiat, a Latin word for let it be done. It became money by government decree. It became fundamentally a debt-based instrument backed by nothing but faith in the government and the power of the state to tax its citizens.
And right around that same time, you have this computer revolution just starting to kick off.
That's the other crucial piece. The rise of the internet and digital securities trading happened in parallel with this decoupling from gold. Financial assets stopped being paper certificates that were physically moved between vaults in lower Manhattan.
Right.
They became digital data points, blips on a screen. But the real moment of acceleration, the point where everything was kicked into high gear, was the 2008 financial crisis.
Of course. 2008 comes up in almost every deep dive we do on finance or geopolitics. It really was the breaking point of the old system.
It was the near-death experience of the entire global financial system. It almost completely collapsed. And why? A catastrophic lack of liquidity driven by incredibly complex, opaque derivatives. Bets on bets on bets.
And trust just evaporated.
Completely. Banks wouldn't lend to each other, even overnight, because they had no idea if the other bank would even exist the next morning.
So how did the powers that be fix it?
Well, the source argues very strongly that they didn't fix the root cause. They didn't simplify the system or get rid of the dangerous complexity.
They kicked the can down the road.
They built a bigger, more powerful can-kicking machine. The G20 met, and they essentially created what the source calls Bretton Woods 2.0. And the core strategy was simple. Centralize everything. Centralize liquidity.
So they connected all the central banks?
They connected the Federal Reserve, the European Central Bank, and the Bank of England more tightly than ever before. They created swap lines so they could print money and move it around the globe in seconds to plug any holes that appeared.
So instead of letting the risky banks fail, they just made the safety net bigger and put the central banks, and by extension the taxpayers, at the center of it.
And at the same time, they built the infrastructure for total observation. This is what Hester Bates points out. Over the last 15 years, under the guise of safety and anti-money laundering, the legal and technical pipes for a CBDC system have been quietly and methodically laid.
Wait, what do you mean? So the laws that were supposedly about stopping terrorists and drug dealers?
We're actually building the surveillance dragnet needed for a CBDC. That's the argument. Think about know your customer laws, KYC.
Right, where you have to upload your passport and a utility bill to open any kind of financial account.
Exactly. Those laws forced banks to digitize every aspect of user identity and link it to their transaction history. They created the database. That surveillance infrastructure is the absolute prerequisite for a CBDC to function. You couldn't have a CBDC without that grid already being in place.
So they built the highway, and now they're just introducing the car that's going to drive on it.
That's a perfect way to put it. And it's so ironic, isn't it? Because if you look at the surface level of the tech world, crypto, DeFi, all these new apps, it feels like finance is getting more decentralized, more power to the people.
That's the marketing, for sure.
But the source argues that's a total illusion. The financial plumbing, the deep infrastructure is becoming more hyper-centralized than at any point in human history.
Hester Bays points out that fascinating detail about stock ownership. I think most people have no idea how this works.
It's shocking when you first hear it. If you go on your brokerage app and you buy a share of Apple, do you actually own that share?
I mean, I think I do. I paid for it. It says 1 share on my screen. I get the dividends. I can vote at the shareholder meeting.
But you don't actually hold the legal title. What you have is a contractual claim, an IOU, from your broker. Your broker, in turn, has a claim against a larger custodian bank. And that custodian has a claim against the central depository, like the DTCC.
So it's a whole chain of IOUs.
It's a chain of IOUs. The actual owner on the books is an entity called Seed & Co. It's a custodian system.
Yeah.
And the risk is that if any link in that chain breaks...
You don't have the asset. You just have a claim that might be worthless.
Exactly. And this is part of why the push for CBDCs is happening. The sales pitch is that it can solve that counterparty risk by consolidating everything at the very top with the central bank. But in doing so, it creates the ultimate choke point, the ultimate centralization of power.
Okay, so that's the skeptic's view of the history, a 50-year march towards centralization. But surely the government isn't pitching this as, hey, everyone, we want to control your every move.
Agrees. No, of course not.
They have a sales pitch. They have a brochure. So, Section 4, the official pitch versus the skeptic's reality. Why do they say we need this thing?
And to be fair to the roundtable participants, they are very clear in acknowledging one valid, powerful argument in favor of CBDCs.
Okay, what is it?
Transparency in public funding.
Explain what that means.
Okay. Imagine the government allocates, say, 10 million euros to build a new bridge, or it sends $1 billion in foreign aid to a developing country. Right now, what happens to that money?
It goes into the banking system, and a lot of it seems to disappear.
It vanishes into a black box of contractors, subcontractors, consultants, and offshore accounts. Corruption is easy. Cash envelopes, inflated invoices, consulting fees.
Right, the leakage problem.
Exactly. With a programmable, traceable CBDC, the public could, in theory, see exactly where every single cent of their tax money went. You could program the money so it can only be spent on steel and concrete for the bridge, not on luxury dinners or yachts.
That actually sounds amazing. That sounds like a huge win for democracy.
It does, and the skeptics in the source material admit it. They say, look, if CBDCs were strictly limited to government spending, if it was only applied to the state's own wallet to track its own spending, it would be a massive victory for transparency and against corruption.
Oh, there's a but.
But that is not the plan. They aren't just building this system to police themselves, they're building it for you, for everyone.
Well, what's the sales pitch for me? As a regular person, why do I need a Fed account or a digital euro wallet?
They pitch two main things: safety and inclusion, or efficiency. They'll say commercial banks are risky. Just look at 2008. If you keep your money directly with the central bank, it's completely risk-free because the central bank can't go bust. It can always print more money.
Okay, that's the safety argument.
Then they'll pitch European uniformity, or modernization. A smooth, standardized digital payment system for the whole Eurozone to compete with Visa or MasterCard. They'll claim it will be cheaper for merchants, faster for consumers.
Right, but the roundtable participants, they're not buying any of it.
Not for a second. They call it a solution in search of a problem.
Why? Because my Visa card and my Apple Pay work just fine.
Exactly. The current digital payment system, for all its flaws, works incredibly well from a user's perspective. Payments in Europe and the US are already effectively instant, they're cheap or free for the consumer, and they're ubiquitous.
So there's no consumer demand for this?
None. Zero. No one is marching in the streets shouting, please shut down my bank account and give me a direct account with the central bank. The system we have works just fine for the end user.
So if there's no demand and the current system works, Why are they pushing it so hard?
Control. It always comes back to control. And this brings us to the trap that so many well-meaning people fall into, the "I have nothing to hide" argument.
Oh, I hear this constantly. Let them see my transactions. I'm just buying groceries and paying for Netflix. I'm not a terrorist. I'm not a criminal, so why should I care if they see what I spend my money on?
The source material attacks this mindset, and I think it's for a very good reason. They argue that privacy isn't about hiding crimes, it's about autonomy. It's about the freedom to be different, to make mistakes, to be unpopular.
And they use a really dark, really specific historical example to prove this point.
They do. The Netherlands in World War II. And this part of the discussion is chilling, but it is absolutely necessary to understand the stakes.
So what happened?
Before the war, the Netherlands had one of the most efficient, well-organized, and detailed population registries in the entire world. It was a masterpiece of modern administration. They knew where everyone lived, their religion, their family members, everything.
And at the time, that was seen as a good thing, good governance. It helps with city planning, tax collection, social services.
Exactly. The intention behind building it was good. It was modern, efficient, and rational.
Right.
But when the Nazis occupied the Netherlands, they didn't have to build a surveillance state from scratch.
It was already there,
Yeah.
waiting for them.
It was already there. And that good data, that efficient registry, allowed the Nazis to identify, round up, and deport the Jewish population more efficiently and more completely than in almost any other occupied country.
That is a terrifying thought. It means the original intent of the data collector doesn't matter nearly as much as the intent of the person who eventually gets to use that data.
That is the core warning of the entire discussion. You might trust your government today. You might trust the current administration. But can you guarantee that you'll trust the government in 10 years? Or 20? Or that a radical group won't take power in a crisis?
Once the infrastructure for total control exists, once that central ledger is built, it's just a weapon lying on the table waiting for someone to pick it up.
And even if nobody ever picks it up, it creates what they call a chilling effect, doesn't it? Just the knowledge that you're being constantly watched changes how you act.
Absolutely. It's the panopticon effect from philosophy. The prisoner behaves because he knows the guard might be watching, even if he isn't. You stop taking risks, you conform.
You don't donate to that controversial political cause because you know it'll be on your permanent record. You don't buy the book that might be flagged by some future algorithm. You become a passive subject, not a free citizen.
And innovation dies in that kind of environment because innovation requires risk-taking and nonconformity.
That's right. And this connects to the bigger picture, beyond just our individual rights.
Yeah.
Section 5, geopolitics and the closed system. Because the U.S. and Europe, they're not building this in a vacuum.
No, the whole world is changing.
We are rapidly entering a multipolar world. For the last 50, 60 years, the U.S. dollar has been the undisputed king, the global reserve currency. If you wanted to buy oil or trade internationally, you used dollars.
The dollar hegemony.
But that hegemony is visibly fading. You have Russia, China, the BRICS nations. They are actively and openly building their own parallel payment rails, specifically to bypass the U.S. dollar and the SWIFT system.
So are CBDCs a kind of defense mechanism for the West?
They're a tool to secure what's called monetary sovereignty. In this new world, if China has a digital yuan that is programmable and traceable, they can enforce their own capital controls instantly. They can block foreign interference. They can run their own monetary policy without worrying about Washington.
And the West feels it needs its own version to compete.
Exactly. It's a new digital arms race. They are afraid of losing control of the global financial standard that has benefited them so much for so long.
But the experts in our source talk about a worst bank scenario that could result from this idea of closed system. What do they mean by that?
It's the fear of the closed loop. Right now, today, if you don't like what the banks or the government are doing, you still have escape hatches. They're getting smaller, but they exist.
I can take my money out as cash.
You can take out cash. You can buy physical gold or silver. You can, with some difficulty, move your assets to a different jurisdiction. You can opt out of the system, at least partially.
But a CBDC system, the goal is to close those exits.
That's the fear. If cash is banned or just marginalized to the point of being useless, made illegal for any purchase over $50, and gold is made difficult to transact with, then you are trapped inside the digital ledger. There is no exit.
And once you're trapped inside,
Then a policy called financial repression becomes trivially easy to implement. As we mentioned, they can impose negative interest rates directly on your savings. If the government has too much debt, which they all do, they can just decide to shave 2% off of everyone's savings account overnight to pay it down. A direct tax, no legislation required.
Or, in a crisis, they could just turn off the ATMs,
Yes,
metaphorically.
exactly. Think about a bank run today. People panic, they line up at ATMs, it's chaotic, it's on the news, it's bad PR for the government. In a CBDC world, there is no line. They just change a single line of code.
And your wallet app on your phone just says service unavailable or weekly withdrawal limit reached.
Yes. It allows the state to freeze the entire economy instantly to save the system at the direct expense of your access to your own assets. It's the ultimate tool for crisis management.
It's total control. But the source material, it takes us one step further. It gets really speculative. Section 6 looks at the future. AI, universal basic income, and compliance.
This is where they start to connect the dots and ask, why would they need this unprecedented level of control specifically in the coming decades? What problem is this a solution for?
And the answer they come to is the job market.
It's the job market, yes. The experts in the roundtable discuss the rapid, exponential rise of artificial intelligence and what happens if AI really does replace a massive chunk of both white-collar and blue-collar jobs.
Lawyers, truck drivers, coders, accountants, radiologists, the list goes on.
If that happens, we could be facing structural mass unemployment on a scale we've never seen before. The useless class scenario that some historians have talked about. People who simply have no economic utility to the market anymore.
It's a bleak thought. So in that world, how do you prevent mass social unrest? How do you keep millions of unemployed, angry people from tearing down the system?
You give them money. You implement a universal basic income, a UBI.
Free money to keep everyone fed and housed.
Right, but the source suggests this comes with a huge trade-off, a catch. They call it the golden handcuffs.
As in, here is your monthly UBI payment, but
it is distributed via CBDC, and it is programmable. You get the money you need to survive, but you must behave. You can buy groceries, but you can't travel outside your designated zone. You can pay your rent, but you can't donate to a political protest movement the government doesn't like.
it sounds like a new kind of feudalism. The lord of the manor feeds the serfs, but the serfs belong to the land and can't leave.
And the really scary part, which Rabbi Etel points out, is that people might willingly, even happily accept it. If you are desperate, if you have no job prospects, and the state offers you economic security, food, shelter, healthcare, you will most likely accept the loss of your privacy and autonomy with a smile.
You trade your freedom for bread. It's a very seductive, very dangerous trap.
It is.
But hold on. What about crypto? People always bring this up. What about stable coins like Tether or Circle's USDC? Aren't those the escape hatch from this system?
The source is very, very critical of this idea. They argue that these so-called stablecoins are not an escape hatch at all. They're just a crypto wrapper for the exact same debt-based fiat system.
How so? Because they're backed by dollars and government bonds.
Exactly. Circle, the company that issues USDC, holds a massive amount of U.S. Treasury bonds as collateral. If the U.S. government decides to crack down, they can seize that collateral. They can order Circle to blacklist certain addresses, to freeze funds.
So it's not truly decentralized. It's not outside the system.
Not at all. It's just the old system wearing a new, trendy digital mask. The argument is that unless a digital asset is truly decentralized, like Bitcoin, it is still vulnerable to being absorbed into the same grid of control.
So is it hopeless then? Are we just marching inevitably towards this digital prison? Which brings us to our last section, Section 7. Can it be stopped?
Well, there is resistance. And interestingly, the source points out that the Netherlands, despite its tragic history with the population registry, has been a bit of a thorn in the EU's side on this issue.
Oh, really? How so?
The Dutch parliament has actually voted against certain aspects of the proposed digital euro. They've put up a fight, demanding that principles like anonymity for small payments and, crucially, non-programmability be written into the final EU text.
Okay, so they want a law in the books that explicitly says it is illegal to program this money.
Legally, yes. They are trying to build legal firewalls to protect citizens. But the experts in the roundtable warn about the loophole. And this is the critical distinction between law and code.
Okay, explain that distinction.
You can write a law today, you can pass it through Parliament, and it can say the government shall not program the money to have an expiry date. That's a piece of paper, it's a legal promise. But if the technical capability to program the money is built into the software architecture from day one,
then a future government in a future crisis can just change the law and flip the switch that was already there.
precisely. If the button exists, Someone will eventually find a reason to press it. A war, another pandemic, a climate emergency, a financial depression. A crisis is always the excuse to suspend the rules. The only true protection is what's called privacy by design.
Meaning you build the system so it is technically impossible for the issuer to track or program the funds. You make it like digital cash.
Exactly. But that is not what is being built right now.
No. They're building the button.
Yeah.
They're just promising for now not to press it.
That's right.
There is also the incompetence argument, right? This part of the source material actually gave me a tiny glimmer of hope.
Agrees, yes. This is the cynic's ray of sunshine. The argument that governments and big tech, for all their power, are actually struggling to get these massive data models and AI systems to work right. They hallucinate, they have biases, they crash, they have bugs.
And the case study for this is Nigeria.
The INERA. It's a perfect real-world case study of what can go wrong. Nigeria launched a CBDC and tried to force adoption by aggressively limiting cash withdrawals. They tried to strong-arm the entire population into the new digital system overnight.
And what was the result?
Absolute chaos. Physical cash ran out. The digital system wasn't ready to handle the load. The app kept crashing. Merchants couldn't process transactions. The entire economy stalled. People rioted. It was a complete disaster.
So maybe they're just too incompetent to successfully run a totalitarian financial system.
It's a possibility, but the attempt alone causes massive real-world damage to people's livelihoods. Incompetence can be just as dangerous as malice. You know, just because the prison guard is clumsy doesn't mean you aren't in prison.
The experts also touched on a more philosophical worry, something they called the last man mentality.
Yes, this is a reference to the philosopher Friedrich Nietzsche. His concept of the last man is a type of human who has lost all drive for struggle, for risk, for greatness. He just wants comfort and safety, a full belly and no worries.
And the fear is that modern society we have become that.
The speakers in the roundtable express a real fear that the public is too passive, that we've become sheep, as one of them puts it, that we are so comfortable with our one-click ordering, our seamless payment apps, our convenient lives, that we will sleepwalk into a digital prison simply because it's easier than fighting for the hassle of cash and privacy.
That one hits home. Convenience is the ultimate drug. We trade our privacy for convenience every single day with every app we use.
We do. And as CBDC just asks for that final trade, the complete surrender of financial autonomy for the promise of a slightly faster checkout and a safer system.
So let's try to wrap this all up. After this whole deep dive, what is the final summary here? What's the big takeaway?
I think it's that we are moving from a system based on trust, where you hold a physical token of value like a gold coin or a cash note, to a system based on control, where value is just data on a ledger that is owned and operated by the state.
And this isn't science fiction. The infrastructure has been built over the last 15 years. The pilot programs are running right now in China, in Nigeria, and in wholesale tests between central banks.
This is the reality of the next decade of finance.
And what's the provocative thought from the source material to leave our listeners with?
The source emphasizes, again, that privacy isn't about hiding secrets. It's about autonomy. And they ask this question: if every single cent you ever spend is recorded, analyzed, and potentially judged by an algorithm or a government policy, do you ever truly make a free choice again?
If I know the bank is watching and the government is watching the bank, do I buy that controversial book? Do I donate to the strike fund? Do I travel to the protest?
Probably not. And if you censor yourself like that, you aren't free, you are managed.
The Crossroads. That's the title of the source. And they say we still have a window, a small one, to make our voices heard. A window to demand that cash remains legal tender. To demand that privacy is engineered into the code of these new systems, not just promised in a law that can be changed on a whim.
But that window is closing. And it's closing fast.
Well, that is both terrifying and illuminating. I'm definitely going to look at that 20-euro bill in my wallet a little differently from now on.
Hold on to it while you still can.
Thanks for listening to The Deep Dive. Stay curious, stay critical, and we'll catch you in the next one.